Welcome to the second panel, our third session of Quantify's New York conference, and navigating transition away from IBOR. IBORs are interbank offer rates, especially LIBOR rates fixed in London, are with us for a long time, at least since the 70s. But in a couple of years, they will be replaced by other rates, introduced by local regulators. Why is it happening? One big reason is a LIBOR manipulation by traders from Barclays and other banks uncovered in 2012. Apparently, these traders took the term fixed rates too literally. But there are other reasons for transition as well. Today, we will talk about history of LIBOR transition, its progress, some of the issues, and what we can expect to see in the future. And we have the perfect panel to cover these topics. We have to the left of me, Priya Misra, a Managing Director and Global Head of Rate Strategy with TD Securities. Then Gary Levin, a Director and Head of the Fixed Income Market Risk for America, SocGen CIB. And Leon Michon, Managing Director of Global Valuation Group with BofA. All three panelists have many years of experience in fixed income markets and are currently directly involved in transition away from LIBOR undergoing by their banks. So without further ado, let me start by asking panelists to tell us more about history and background of IBOR transition. Priya, can we start with you?
Sure, happy to. I think, when you think of those stages of grief that we all have to go through, right from denial to acceptance, I think the marketplace is somewhere between investors, issuers, hedgers. I think people are across the stages. I think I've probably moved from the denial stage to the acceptance stage. The LIBOR is going away. I think we should all take heed. The regulators in the US have been pretty clear. So New York Fed President Williams a couple of times has actually invoked Benjamin Franklin when he talked about the two things, that we've all heard, two things certain in life, death and taxes. And he said it's death, taxes, and the death of LIBOR. So he's elevated it to that level. I think essentially what the regulators are telling us, to Dimitri's point, because LIBOR was being manipulated, they've been wanting to get away from LIBOR actually for a pretty long time. I think, from the regulator standpoint, they could have said if it snows in New York, LIBOR goes away. They would have done it, except legally they couldn't do it. And then I think what gave them a shot in the arm was the FCA's head in 2017, who said that, look, banks want to leave the LIBOR panel. And so the FCA head, Andrew Bailey, said, which is the regulator of LIBOR, said that banks have voluntarily committed to only provide rates or submissions up until the end of 21. And so really, a lot of us are working with that as the deadline, not knowing what happens afterwards. LIBOR may well exist after that. But I think from the regulatory standpoint, from a lot of us, there is no guarantee that LIBOR will exist in the way we see it today, where it's a fairly well-established rate. It just may not exist. Some of you may have heard the idea of a zombie LIBOR. I think it's quite a big risk that we live in the zombie LIBOR stage beyond end of 21. And what I mean by that is a LIBOR that exists with maybe 6 market participants who are submitting LIBOR, or 10, certainly lower than the 17 that submit 3-month dollar LIBOR today. And that's because a lot of banks have realized that the legal liability of submitting LIBOR is very high. And all of this comes from the fact that there is very little unsecured bank funding transactions that happen today in 3-month space. So the way for a bank, from a bank standpoint, I need to submit a LIBOR. Actually, I should not say TD is not a LIBOR submitter, but if we were, we have to submit a LIBOR based on our own unsecured 3-month funding transactions, except we don't actually fund at the 3-month point. So then I have to look at the market, use expert judgment, and that's where that legal risk for a bank comes in. So there's a high chance that a lot of these banks, sorry, I'm doing something wrong. LIBOR tends to get people excited, so I wonder if that's what's happening. I'll just stay away. So here, let me move this away. See, that's ominous. We start talking about LIBOR and everything starts freaking out. It is a very important number. It's embedded in a bunch of contracts. I think what the industry is dealing with, what we're dealing with at TD, is sort of a multifaceted approach. We have to deal with our legacy book. So we've got a bunch of LIBOR embedded in derivatives, in cash, in contracts, in credit commitments. I feel like it's a Pandora's box. We keep finding new places where LIBOR has made its way, and that's something we need to figure out. And what the arc, sorry, maybe I'll hold it. How about that? Okay, maybe this will work. Try not to karaoke. So, I think the legacy part is something we all have to deal with. The fallback is the biggest component of that. So, if LIBOR doesn't exist, what do you do with anything in your legacy world that has LIBOR? There should be a good fallback. Most fallbacks I have seen are formed under two categories. Either you poll a bunch of banks and ask them for a LIBOR. Well, if they're not submitting a LIBOR, I can pretty much assure you they're not going to provide you a poll rate. So that's a horrible fallback. The other fallback is let's use the last LIBOR. Except when I put that in the contract, it was supposed to be a floating rate. If you've just made it go to the fixed rate of the last LIBOR, that's not ideal. So we all have to figure out the legacy side. Derivatives, I think, in the cleared world are much easier. And I'm sure we'll talk about it. In the uncleared world, much harder. And then there's the cash market. So we have to deal with the legacy issue of derivatives and of cash. Then we have to deal with the new world, right? They often talk about what do you do when you're digging yourself in a hole, like just stop digging. And that's part of it, what we have to deal with right now is stop taking more LIBOR exposure. Because this rate, whether it's end of 21, whether it's 22, whether it's 25, I don't know when it happens, it's going away. And so let's not add to our LIBOR exposure, and that's where SOFR comes in. And this is a worldwide global transition. So in the UK, it's SONIA, in the US, it's SOFR. I think we all have to start dealing with a new benchmark rate and what the implications are on the cash and derivative side. So I won't go on, but that's essentially how we're dealing with it, is to deal with the legacy book in one side, the new product on the other side, try and build liquidity in the new product, try and issue cash bonds with the new rate. And that's how sort of we're trying to manage this transition.
Thank you very much, Priya. Gary, would you like to add anything?
Yeah, so I agree with Priya on the current state of the markets. However, the one thing that we have to keep in mind, how fundamentally the fixed income market is going to change past the transition. So imagine we deal with all the problems. We deal with legal problems, transition, SOFR, trades more or less liquid. Fundamentals of the market are going to change. What is the swap rate? It doesn't mean what it used to mean. What is cross-currency basis? How do you fund externally? Etc., etc., etc. So there's the fundamentals of the market is going to change, which implies changes to the stress testing, to the capital, etc., etc., etc. And each bank is going to attack it in the future, in the next 2 years, right? But it's a huge process, actually, because we don't know how it's going to look like, the new markets are going to look like.
I just wanted to add a little bit on the is the fallback protocol. So Priya talked about the fallbacks in the cash space. It's very vague, and that will be problematic. In the derivative space, because ISDA has a protocol for derivatives to fall back to SOFR, plus a term adjustment plus a spread adjustment, that helps the market transition when LIBOR ultimately ceases to exist. Now, the reason why this is important is because we have market participants have 30-year LIBOR swaps on their books, but it's highly likely that LIBOR will cease to exist after 2021. So that swap that you think you have on your books and you understand the risk profile, actually you're already exposed to SOFR and SOFR volatility, because the fallback will be to SOFR plus a term adjustment plus a spread adjustment. At this point, ISDA is currently digesting the latest fallback protocol, what they term the final parameters. And so the fallback will likely be, first, regarding SOFR, give us an overnight secured rate to adjust from that overnight secured rate to a term rate equivalent. The compounding in arrears method has been determined. There still is some debate around whether there will be a backward shift or there'll be a lockout, so that market participants know what coupon to pay. You need a couple days to figure out if you have a backward in arrears compounding. You need a couple days to figure out what your swap payment is going to be. So the two different proposals that are still on the table are to shift back that window by 2 days, or to have a 2-day lockout. And so that will allow existing derivatives to adjust the overnight SOFR rate to a term equivalent rate, 1 month, 3 months, 6 months, etc. As far as the spread adjustment, as we all know, LIBOR is a credit risky rate, and SOFR is secured. And so to account for that risk premium, that credit risk premium, the fallback protocol is converging on a historical mean or median methodology. So what that will mean is Bloomberg will look at the historical 1 month compounded in arrears SOFR versus the 1 month LIBOR rate, and will either compute a median or a trim mean adjustment, and then ultimately publish these adjusted risk-free rates for the fallback. And so while that protocol is still being determined, it is good to know that that methodology is almost final, and the market will have some clarity around what the likely fallbacks will be in the derivative space. Just one more point on the fallbacks, and why we think it's important at Bank of America is because of the likely value transfer when the fallback is triggered. And so not only will there be a value transfer when the industry shifts from discounting at OIS to discounting at SOFR or Ester, but there will also be a value transfer that occurs when the fallbacks are triggered from LIBOR to SOFR. And so trying to understand how that may unfold is something that we're focused on. There's certainly a lot of complexity. It's still TBD, but it is good that the industry has some additional clarity around how that fallback will likely proceed.
Priya, you are involved in discussions on fallbacks, right? So would you like to add to?
Sure. So I think the ARC has been working on fallbacks for new products that are going to be issued on the cash side. Fallback on mortgages, on floaters, etc. A lot of people, I think, Leon's point's very valid. We're all waiting for the ISDA fallback, because from an issuer standpoint, I'm hedging my cash with a derivative. I'd really like harmonization of the two fallbacks. So I think a lot of us will actually move once we see what ISDA's picked, I think, and that's expected by the end of the year, right? Hopefully, I feel like ISDA's asked us gazillion times. At this point, I'm just in the camp where just tell us what you're going to do, because you've consulted us so many times. But it's a very important decision, which is why they actually want to get market opinion on this. Another point, actually, to Leon, maybe you have something to add, is on the pre-cessation trigger. It's something that ISDA has opened up for consultation. Should there be a pre-cessation? Like, what's the trigger? When does the fallback hit? Is it when LIBOR no longer is published at all? Or is it when LIBOR is maybe not representative? And this is why I wish I was a lawyer, but these are legal terms, or a regulatory term. Is it representative or not? Because it's possible that LIBOR is still being published, because according to the ICE rules, LIBOR will be published as long as there are more than five or more banks that submit LIBOR. But imagine there's 6 banks that submit LIBOR. So if I'm ICE, I'm still publishing it, but really 6 banks, how are you even trimming it? Maybe they drop the trimming, because if you're going to trim the top and the bottom, you're really averaging 2 or 3 bank submissions. Not ideal. Maybe they just average the 6. At that point, FCA, which is the regulator of LIBOR, might actually say this is no longer representative. Well, does the fallback kick in at that point or not? When ARC debated this, they wanted to actually put it in the cash products that a pre-cessation trigger should exist. So if a regulator says that LIBOR is no longer representative, you can the fallbacks get triggered. We don't know if ISDA is going to adopt that pre-cessation trigger or not, but that's something I'm certainly watching, and I think the whole market is watching. I actually think this ISDA consult or the protocol, when it's out, it's a key issue absolutely for the derivative market, but also for the cash market. Because now for any ALM hedger or anybody involved in ALM, at least one side. And the market's going to the basis markets will adjust right away to whatever spread they pick, to the pre-cessation, and then we can start actually ensuring that our cash side is in line with the ISDA. Or we know if it's not in line, we know where the mismatch is, so that we know where the potential issues could come in if LIBOR does go away or become unrepresentative.
Okay, thank you. So if we talk about transition from USD LIBOR to SOFR, so what's the progress so far? Pun intended, right? So Gary, you are in your bank, right, responsible for this. So can you start?
Yeah, sure. So for now, what we've seen is large volume of futures trading on SOFR, on CME and LCH. That's a good thing. It probably lags a little bit, Priya. You probably agree, the Eurodollar futures in terms of development time.
Right.
First year of Eurodollar futures probably was faster, right? So, but it's a good thing that at least there's a trading on a short end of the SOFR curve. Unfortunately, the reason for the high trading is actually perverse because you had this repo funding squeeze, and a lot of people realize they have a funding exposure, and the best hedge for funding exposure could be SOFR. So it could be that people are hedging SOFR spikes using futures on SOFR, which is kind of a strange reason to trade the market, right? And the other reason is obviously there's no cash market. There are really no cash securities, right? Looking the other way, if you look at swaps market, there's hardly many swaps trading past 2 years in maturity. And again, short-term swaps is really a hedge against spikes and funding. Long-term swaps, that's the real hedge of the cash market. This is really the true derivative market. And since there is no cash market development yet, we haven't seen too much of long-term swaps traded. So yes, the volume is increasing, but we are far away from liquid swap market to be kind of reliant on this rate.
It's a classic chicken and egg situation, I would argue.
Right, exactly.
Right? The cash market needs, I think, a term rate. To get the term rate, we need a derivative market. So we kind of all point at each other, and I will tell our derivative traders, you guys need to build liquidity. And then they say we need the end users to hedge, because otherwise, how do you build liquidity? Well, to get the end users to hedge, you need the cash market, which needs the term rate. It's a bit of a vicious cycle right now. I think what can change it is once we get backward-looking average SOFR. So there's an obsession in the market for this forward, because we're all used to LIBOR, right? And I've heard, and I think I underappreciated not being in risk management. You can tell me how wrong I am, or operations, how difficult it is to replace 3-month LIBOR, which is a forward-looking rate, with a backward-looking overnight rate. It is very hard. I've said, well, have a backward-looking average, except a backward-looking average doesn't exist right now. Now, the New York Fed is likely to publish a backward-looking average. It's interesting, they don't want to call it backward-looking because it sounds like backward, which I think is not good marketing. They're just calling it average, but it is a backward-looking average for 3 months. Once we get a 3-month rate, we should be able to substitute a 3-month LIBOR with a 3-month SOFR. And now a lot of ARM products, floaters, etc., can kick off or start issuance based on SOFR. Then I think some of that hedging need will automatically come by. Once you get that cash product going, I think we should get that liquidity. So both markets have to, I think, build at the same time. I think waiting for another one to build it has to go hand in hand, which is, I think, what's not happening right now. We only have one cash market that's really taken off, which is the GSE floater market. And it makes sense because the GSEs are on the arc. There's a little bit of, if you're on the arc, there's a little bit of rah-rah, you have to have drunk the SOFR Kool-Aid. And so they all want to go out and issue. But we really need far more acceptance on the mortgage side, on the corporate side, on the bank side. I think you have to get that more of this cash product going, for which we need a term rate. Because nobody wants to index any cash product to an overnight rate, which spiked to 5.25 2 months ago. When it spiked from 2.5 to 5.5 unexpectedly. So nobody likes an overnight rate, you would imagine, on the cash side. So we really need a smoothed average rate to emerge as a standard, I think, Fed blessed rate, which is why I think this Fed rate actually could be pretty key in the transition. And I wish they would do it today, except it takes a while for the Fed to actually publish. I mean, we can all create a compounded 3-month SOFR right now on Excel in 2 minutes. But for the Fed to publish it, they need it in the Federal Register. They need to consult with the market. They're in that process right now. So I think that could be a big step in trying to get this derivative liquidity up.
Well, also derivative liquidity could be increased if CCPs go through with their transition, big bang, as they call it, in October. So for October in 2020, both LCH and CME plan to change to SOFR discounting from Fed funds discounting on the cleared products. That basically forces the market to recognize they have SOFR risk on their books already. That's what Leon is mentioning, that the risk is already on your books. You just don't recognize it, right?
Yeah, I think that's a huge catalyst to drive the derivative market activity and help with the construction of a term structure. And Esther might go even sooner than that in June of 2020 on the LCH. So that will be a major catalyst for the market. That will open up a tremendous amount of basis risk in everyone's derivative books, because their existing bilateral swaps will still be discounted at OIS, yet all of their cleared swaps will be discounted at SOFR. That also opens up a tremendous amount of legal work and negotiations with your trading counterparties on a bilateral basis, because you will be incentivized to switch your CSA terms, bilateral CSA terms, to mirror what the CCPs are doing. You don't want to have to manage all that basis risk. It's costly and it's onerous. But to switch over all your bilateral discounting, you'll need to renegotiate all those CSAs. Someone will win, someone will lose. In the CCP Big Bang that Gary talked about, the CCPs have a compensation framework already designed, so that when they make that switch, they will make the loser whole at that point in time. But in the bilateral space, there is no equivalent compensation mechanism, and that opens up a lot of potential risk, as the industry continues to move towards SOFR discounting.
Do you think that CSA negotiations would happen prior to Big Bang, or pretty much everyone is waiting for CCPs?
I personally think that people will wait for the CCPs to move, but I do think that folks will try to pre-position for the inevitability. It's something that we've been looking at and evaluating at Bank of America.
But swaptions could be really tricky, right? Because they settle into a cleared swap. So now think about a swaption which is right now being valued at OIS. It's going to clear into a cleared swap that will, after, let's say we're beyond October 2020, the swap will be now valued at SOFR. So there's an immediate, I would say, mark-to-market impact. Any thoughts on how that should get solved, or your ideal scenario for how to solve swaptions?
I think it's very complicated. I think in some respects the market is already converging to that inevitability. I think that I'm actually more worried about CMS product, there's no clear path or fallback protocol for CMS, given that there's no term structure at this point for SOFR. There's a lot of structured notes and other exotic derivatives that are based on CMS, and I think that is one of the bigger challenges that I'm worried about.
Yeah, clearly, exotics book is a big challenge. I mean, for swaptions, LCH and CME have two different plans apparently for how to handle swaptions. CME is trying to create a mechanism to compensate, basically the same way they do with swaps, to compensate the cleared swaptions. LCH is basically, for now, is saying it's not our problem. We're gonna move all the swaptions and change the reference to uncleared swaps, and then you market decide how to go about it. And I think the big picture story about the whole transition is about legal risk. Everything we do is about legal risk, and that's legal risk for every participant: for the banks, for investors, for clients, for CCPs. So CME and LCH are in the middle of this transition, and they have to protect themselves also, right? Because they cannot create valuation problems for the participants or being liable for anything that they do. So there's a lot of conversations going on between different communities, and it's not absolutely clear how it's going to go, especially for product like options, swaptions.
I just want to add to the comment on the legal risk. I think that the legal risk and liquidity risk is heightened in the cash space, where the fallback path is much more vague. Priya was mentioning before, in some cases you have to poll. She said that was problematic. In some cases, you revert to the last rate. In some cases, you have to get majority or unanimous consent of the bondholders to make a change. And that is very logistically challenging. The calculation agents, the issuers, they are going to have to deal with this problem. And, the clarity of the fallback language in different types of structured cash products will be an influence on the potential liquidity of that product, post 2021.
A specific example is CLO product, which has an asset and liability. So on the loan side, you negotiate the base rate for the loans from LIBOR to SOFR, but then you find the liability side of CLO structure, you have to find all the bondholders and different tranches, right? So it's a question of waterfall. So you have to negotiate what each tranche is going to get in terms of waterfall cash flow, and that opens up a whole legal question, right? So there's a whole set of products which are very difficult to transition. And based on that, you can argue that LIBOR will have to exist in some sense, just for the runoff of those products.
Okay, thank you. This transition process is by no way smooth, right? As was evidenced by spike in repo rates in September. So maybe you can expound on this. Priya, starting with you, tell us what's happened really.
Sure. I feel like I was a repo analyst in September. I think we were all repo traders, given the move in repo rates. I mean, our sense was, and I'll be brief on this, I've certainly written a lot on this, so happy to talk offline, was a supply-demand mismatch for reserves. I think the Fed, and we've all been trying to figure out what is equilibrium level of reserves in the banking system. Pre-Lehman, it was 0, because banks didn't hold any excess reserves. Now the number, in our view, is much, much higher, closer to $1.5 trillion. And the Fed had been letting reserves run down. And unfortunately, the Fed needed to see the market seize up in repo for them to acknowledge the problem. So the bad news is that they didn't see it coming. But I have to say, once they saw what happened, they were very quick to diagnose the problem, that there is not enough reserves. And then they were very quick to act. I'm actually very impressed. I was very critical that the Fed didn't see this coming, but now I think they've understood what the problem is. They're doing repo. Actually, today they announced the repo operations up until year end and beyond. They're doing a ton of overnight and term repos to allow enough reserves to enter the system temporarily. They're also buying bills to increase reserves permanently. So I think, will we get repo spikes? Sure, that's the nature of the market. I actually think it added to SOFR credibility. If SOFR had not gone up in September, I would have said this is another silly rate, except it did move up as it was supposed to move up. It's a truly transacted rate. When repo moves up, SOFR moved up. But I don't think you're going to get a 5.25 or that sort of a spike, because the Fed has these facilities in place. Can you get a year-end turn? Today was trading 3%. Repo right now is 150. Sure, can you get a 150 basis point spike for 2 days around year-end, or 3 days because we have a weekend? Sure. But it's 3 days. If you're thinking about a 1 month, 3 month SOFR, it doesn't impact you. You're unlikely to see the 5, 6, 10% because the Fed is on top of it. So I think it was a short-term issue addressed, but we're going to have it's like any other transacted rate. It will move around, which is why it's very important to think of an average and calculate vol versus an average 3-month rate rather than this overnight rate.
Well, I'll have to disagree with you a little bit on that. I think that
that's a good panel.
That's great, exactly.
with any base rate, optics matter. And optics means that some, farming family in Midwest opens a newspaper and they have a loan at SOFR and they see SOFR spiking to 5%. They are shocked, right? Yes, it doesn't impact them. I agree, on 3 months, doesn't matter, right? But optics matter. You cannot have a base rate which is that volatile. Now, interesting outcome of this is Fed effectively, through the repo windows, through repo operations, they effectively now control SOFR. Now, we're getting to the point where, wait a second, we had the LIBOR rate, yes, manipulated, maybe not reliable, but at least it had nothing to do with regulators. It was a market rate. Now, all of a sudden, Fed put themselves in a corner where effectively they're controlling the SOFR rate within some acceptable range, whatever it may be. So, is it good or bad thing? We don't know, right? But you can argue that the free markets, etc., regulators shouldn't be controlling the rate for the whole economy. like that in such a crude way. And second thing is that, in the repo market, and Priya is much more an expert on repos than I am. In the repo market, the way we got here to these reserves, et cetera, is regulations, right? We have balance sheet constraints on banks. We have all kinds of different liquidity ratio on banks, right? So banks are not able to lend and borrow freely overnight, right? Because the balance sheet is affected, right? So, and that's been in works for years now, since 2008 crisis. On the other hand, you have a lot of market players who are constant borrowers on the repo market. So hedge funds or large levered players, their only operation is to borrow overnight. They borrow billions of dollars, tens of billions overnight every day, right? So you have constant demand for cash on the repo market, right? And the supply of cash is limited by banks, by the Fed, et cetera, right? So the moment there's a small disbalance, the people who are losing is not the banks, because banks, repo books or funding books, banks can always fund themselves. What the real risk is that these large levered players who might not be able to fund themselves, right? What happened in September is most of the banks making bid ask on the repo, no problem. It doesn't really matter for the bank where repo rate is 2% or 10%. It doesn't really matter. But now you imagine you're a fund who has to borrow. They have to fund themselves overnight. So they don't care, they have to fund. So rates 5%, 10%, it doesn't matter, they have to fund, right? So there is fundamental disconnect in the repo market. There is a constant demand from significant players who are largely unregulated. And then there is a fundamentally regulatory limited supply. And that problem hasn't been addressed yet.
Leon, whose side are you on? Spikes are good or bad? You can break.
I agree with Gary on the optics point. I think the industry has tried to lobby the regulators to consider an alternative to SOFR, especially in the credit markets. Banks don't like that. When spreads widen, they're gonna get less coupon on their loans, and so that introduces a basis, a funding basis in their lending operations. That lobbying has been unsuccessful. I think the banks have argued that that funding basis will need to be compensated through higher credit premiums, and that's probably a reality. But even with the volatility that we saw recently, with the structural issues in the loan market around SOFR, the Fed is still, and the regulators are still determined to end and transition away from the IBORs. And you continue to hear their language and their tone continues to reiterate that at the end of 2021, that's it. They're counting down the days, and that's why I mentioned before it's highly likely that LIBOR will die at the end of 2021.
Okay, let me open for Q&A. We have time for several questions. Yeah, so I think we have to.
Thank you. Hi, thanks for an interesting panel. Samir Shah, NBS Monthly. I own a ton of mortgage derivatives, legacy CUSIPs, that are all indexed off 1 month LIBOR. What's going to happen to these things?
Who wants to take it?
So these are cash products,
Right.
I mean, you said derivatives, but they're really structured cash.
Right, they're CMO derivatives.
They're based,
CMOs.
right. So I'm thinking Fannie, Freddie probably have fallback in there.
No language.
There's
No
not- There's nothing in their language.
There's one Citibank deal which said if LIBOR goes away, then we go to the original coupon.
I know. You see what happened to that deal? That is trading horribly. I actually called the issuer. I called the issuer and said, why don't you just change it? Your bond is trading so horribly. You should probably change it. And they told me about this unanimous consent. They said we need unanimous consent. So we know we can't change it. The only way out is we'd have to do a tender offer or something. I'll tell you, Fannie and Freddie are very involved in the SOFR transition. So I think they're going to do the right thing. I don't know legally whether they can change the old fallback. So I would probably check with, I don't know if it's Fannie or Freddie, but you should probably ask them what they're going to do. They've got massive teams on the legal side, on the mortgage side. What they have been really focused on is how to get new products off SOFR instead of LIBOR. But most companies on the arc had to first figure out the legacy problem. Like I know at TD, we first had to figure out all our legacy problem. We didn't really have a mortgage market, which is why I'm least familiar, but I'm happy to follow up with you because I'm sure there's an ARC working group on this. Because your issue is far more legacy. But every day, if you buy an additional LIBOR product, you're actually increasing that problem. So at least maybe if identify the exposure, figure out what they're going to do. The cash market is much harder, much harder. But I'm thinking because it's Fannie and Freddie, they might be able to resolve it. I don't know legally if there is an issue with they can't resolve it. But I don't have, do you all have anything to add to that? Yeah, that's fairly specific. I'm far more familiar in the floater world or your city perp problem, which they can't. So I think what will happen in most of these cases is they'll buy it back. They'll issue a tender, buy it back, and then issue a new product.
Right, but then if you have an IO and it gets standard, you're screwed.
Right. So there are winners and losers. I know. So I don't like what the Fed keeps saying that we don't want winners and losers. Well, by definition, the whole process is going to create winners and losers. I think they don't want intentionally to say, oh, you will win. But what I keep telling investors is focus on it now. Because sometimes, like I've been looking at some credit paper we own, it is not expensive to get rid of these bad fallback products. So we're just selling it. We're getting rid of any product with bad fallback because maybe they have a solution, maybe they don't, but why take the risk? So to the extent you can, I don't know, you can't probably get rid of all of it, but figure out what Fannie and Freddie have plans.
Well, the problem with all this is there's no alternative. There's no alternative mortgage product to buy based on SOFR. So if you're a mortgage portfolio manager and you have mortgage product, you can't just buy something else. And that's another problem, is that cash market is not there on SOFR. So the LIBOR products are at risk, but alternative is not there yet.
Or buy fixed.
Buy fixed.
And then use OIS. So OIS will exist. See, SOFR swaps, we were talking about, it's not liquid. OIS swaps, I would say up to the 7-year point, are almost as liquid as LIBOR swaps. And so I tell investors, if you don't have a SOFR product, get out of LIBOR, go fixed and swap it to floating. If you really want floating paper, use the OIS market. We know it's blessed by Fed funds, the Fed. They're not going to get rid of that. It's not really a good solution for mortgage derivatives. I get that though.
Thank you. Any other questions?
Okay, so you're saying that people should go to OIS market, right? Do you see any increase in volume in OIS compared to LIBOR currently?
Absolutely. Yes. I think in terms of bid ask, in terms of volumes, I think if OIS swaps up until the 7-year point, I think are as liquid as LIBOR swaps. Huge change from 3 years ago when I think it was a 0 to 2-year market. I think a lot of, particularly banks, when they issue fixed, they would come in and swap with LIBOR. That used to be very popular. You could see swap spread moves. They're all going through OIS. And it's public. You look at their earnings statement when they talk about how they're doing liability hedging. Most large banks are doing liability hedging using OIS. Gets hedge accounting status. So a lot of the accounting issues are not there. So yes, long dated, it's a different story. If you ask me about 30-year, unfortunately, LIBOR swaps are far more liquid. You don't have an alternative. But up until 7 years.
Beyond 5 years, it's not that much, even in LIBOR.
Right. Which is why, the insurance companies have a bigger problem. Right. But
We have time for one more question. I think there was held right there, with the microphone already. Yeah, thank you.
Hans Chung from Bank of America. I heard discussion of the switch discounting from OIS to discounting SOFR, but there's and so that works for collateralized or clear derivatives, but there's still a very large population of uncollateralized derivatives out there in different asset classes. And at my prior employer, the standard was to discount those using LIBOR. What are your views on, like in the post LIBOR world, what that discounting should be?
I think theoretically the right discount rate is the funding, where you're funding those uncollateralized long dated swaps. So the FVA curve, but implementing that is sometimes tricky. I think one could move to OIS discounting for their XVAs and potentially SOFR discounting eventually as more of a convenience. But at the end of the day, it's not those exposures aren't necessarily funded, secured overnight, and so the value is really based on where you're able to fund longer term. So it's more of a FVA, potentially FVA curve type discounting change if you can switch your models. But it is something that I think a lot of the large banks with big XVA books are navigating now, because historically, the simulation of the exposures and the discounting of the XVAs was traditionally done, with LIBOR discounting, and now that will all need to change.
Yeah, I think we would hate to stand between people and their drinks, and happy hour already started. So let me thank the panel and